Well, now we're trying an experiment today. This is something brand new. It's a series that we're going to start, and I'm doing that I thought I would never, ever do, and that is broadcast video as well as audio. After all, we're a radio station. However, given where things are today in the world, and you're using social media, if you don't have video to go with it, then you're probably not there. Now, of course, as all my friends have told me, I have a face for radio. And I never thought I'd get on the video screen, but I'm doing that. So, what is this all about? Well, first of all, you're listening to IBGR, the International Business Growth Radio Network. My name is William Eastman. I'm the host today. This is Finance Monday here at IBGR. And what we do is we talk about the financial aspect of starting, growing, exiting a business, or a separate topic, but certainly just as critical. If you get to a certain point, you've grown the company to its capacity. However, you've decided that instead of selling it, maybe you want to reinvent it. So we kind of handle all of that here on Monday. And so this season, season 12, which started last week, we've talked about how to win in difficult times. And I'm specifically focusing on if you're going to recession proof your business, how do you do that? From a financial perspective. Now, we've got a Tuesday show on operations, and we're going to be doing our live broadcast on that next week. And then we have a Wednesday show where we deal with customers, marketing, sales, etc. And what we'll be doing there is that will be in 2 weeks, where we'll be doing that live. And the idea behind that, and let me kind of share with you just a little bit about radio before we get into the conversation. We try to run as a terrestrial radio station, not an internet station. So if you put on the radio in your car, what you would hear from us is the same thing you would hear from your local station, except that we are very niche focused in that we only talk about business, small business, and especially with a recession either coming or the recession that you're in, depending upon either how you interpret the data or what country you live in, is that this is a bad time for small businesses because the people that get hurt the most in a recession are small businesses and the poor. And since I'm simply focused on business, I'm going to take it from there. Now, what you should have on the screen in front of you, in back, is kind of all of our intellectual property in one board, which talks about how companies grow and evolve. So a lot of the information that we're providing comes from that. And if you're interested in that, then in the comments section, as you're looking at this in either Facebook or LinkedIn, please go ahead and put a comment in. It's going to pop up on my screen and then we sync to this week's show. So the way it's going to work is every week I'm going to talk about the shows that have been done and the shows that are coming up and give you an opportunity to move from the kind of the passive of listening to something to getting involved and interactive. So we're going to be upgrading all of our facilities here over the next week or so. And like I said, our studios are designed to be caves, which makes it easy for radio, not necessarily for this medium here, but we'll get beyond that because it's not what I look like. It's not even the quality of my voice. It is the information that we pass. Now, if you go and hit that link that's on your screen, or if you're listening strictly on radio and you don't want to go to LinkedIn, and you simply got to find me, William Eastman, on LinkedIn, or you're in our group, our Internet Business Radio Community, Internet group, and on Facebook, if you are on our business page at Facebook, and just IBGR .network will get you every place you need to be on those two social media platforms. Now, next week, we're going to be available on several others as we get this done, but I decided, like in any startup, all startups are experiments. This is an experiment, and we have here. But let's get into the content of the materials. All right. Now, if you want to go to the website and get this material, because that's how you're listening, then go to IBGR.network. That's IBGR.network. IBGR is our call sign, just like any other radio station, International Business Growth Radio.network. That is our name, our URL, and our broadcast frequency. When you get to the website, you'll see a navigation bar. Go all the way to the right where it says resources. When you hover over, you see show notes. Click it. And the show that you want is S12, which is season 12, episode 1. And that's where we're going to start. And by the way, these are all backed up by podcast. And so there is no way that you cannot get the information you need. And like I said, when we designed this radio network, not all of our hosts, but a number of our hosts, certainly myself, see this as a consulting and training platform. In other words, we're going to provide the information and help you apply it. That's the goal here. We're not looking to give you a college degree because if you want to do that, go to college. All right. We try to deal with stuff that works. So once you're there and you opened it up, let's talk about this. Now, last Monday, what we did is we talked about the basics of financial reporting. Okay. But let me get to kind of the general theme because I'm going to get through that material pretty quickly. I'm going to assume that what I'm talking about, you know. If you don't, it's easy enough to get up to speed on. Other shows, we're going to get a little bit more detailed. What we learned over the years, this recession coming up is my fifth one in business. And so I've learned either directly or I've learned by doing it wrong or I've learned from others. What do you need to do to recession proof your business? And there are three tracks. Today is just the first track, but the three tracks are: one, owning your numbers. Yeah, absolutely ultimate numbers of your business, because what you're going to have to do is figure out with less revenue, because that's the safe bet right now. Okay, the safe bet is you're going to have less revenue. How do you reduce your cost, which is part of what we talk about today? Then how do you become what we would call the lowest cost producer, which is the focus of tomorrow's show? This has nothing to do with pricing. It has everything to do with taking as much non-value activities out of everything that you do, starting with the products that you build and sell to customers or the services you put together and deliver to customers. How do I eliminate the steps and times it takes to do that? Because steps and time equals money. And if you're able to pull that down the right way, you'll also get some quality enhancements. So you own your numbers, you try to become the lowest cost producer. And then the third part of that process is that you have to understand is that getting new accounts is going to be progressively more difficult. So the smart move is, how do you hold your best accounts? Your best accounts are your most profitable accounts. So the three tracks that we're going to cover in this series all the way through the end of March. Track one on Mondays is owning the numbers. Track two, which is on Tuesdays, is going to be how to become the lowest cost producer. And track three is going to be how do you hold your best accounts. And the approach behind this is the winning formula for those companies who have been able to win in difficult times, which is the theme of season 12 here at IBGR. These are the things required. Now, this is really a two-step process, because part of this is going to be you coming out of, Hugh Hornsby. Hugh, thanks for showing up. And yeah, Hugh, you ought to be on the air because you got a better face than me. Okay, so we'll just go there. But anyway, where I got myself distracted there by looking at comments. That's why I'm not used to this yet. And I'm one of the only broadcasters here at IBGR that does not have a studio engineer, because I think I can do everything. So here's the deal. I will try to do the comments and not get myself distracted. But what I was saying here, it's a two-step process, because the first thing you're doing is you're preparing yourself for the worst so you can get through it. But if you do it right, which is what we're going to share here, if you do it correctly, not only can you get through it, you can strengthen the core of your business. And if you strengthen the core of your business, all recessions end. They all come to an end. Are you prepared for the expansion? That's really what the issue is, because if you're prepared for the expansion where most of the money is made, most of the money is made in the early stages of the expansion. Why? Because most companies come out of, especially small companies, are coming out of a recession limping if they're still in business. All right. So where we're going to go with this is we're taking that general theme, and every week we're going to break it down. I'm going to kind of recover in some ways the key points, but this is also an opportunity for us to interact, because one of the things I miss with radio and is we don't even have the call-in feature, simply because we operate globally and there is just simply no phone number I can hand out for people to call in on. Okay. So this is, if you're on our show notes, this is episode number 1 of the series, and it's the basics. Now, what I've found over the years, and I'm not a financial major, I took the accounting classes in college. Like if any of you went to college and took business, you took accounting classes. That's kind of the end of it. What I know about the financial part of the business is from doing it. There are 3 financial reports that are absolutely essential to your business. One is the balance sheet, and the balance sheet is simply a Polaroid picture. Now I'm dating myself, or a snapshot of what has happened month to month. When you close the books every month, what do you get? What you get in the closeout of the books is basically here's what happened in February, here's what happened in March, here's what happened in April. All right. So you know that there's been a change in the numbers, but you don't know why. You can't say, okay, so what happened? Because what I want to do is I want to backtrack on decisions that we made so that I can go, well, that was good or that was bad. All right. So there's two other statements, and these are all kind of standard stuff you can get off your software. You don't even need your CPA to do this. If they're sending you, if you got a CPA or accountant and they're sending you the files so you can keep your stuff updated, and you're using QuickBooks or something like that, you can get these reports as print the report button. The second thing you got is the income statement. And the income statement is, or better known as profit and loss. And what it begins to tell you is how money is moved around over the period of time. Now, it's pretty good and it gets you about 60 to 70% of the way down the road. The challenge with it is because understand this type of accounting system is done predominantly for banks and people like the IRS. And so, for example, depreciation is something that would show up on the income statement. Now, that tells you as you, or depreciation or appreciation, as you depreciate a piece of equipment, you kind of get a tax break on that. And it looks like you made money from it. The reality is the cigar box is not any thicker. And so you have one last one, and that is uses and sources of cash, or what's called a cash flow statement. Now, you take the cash flow statement and you take the income statement, and now what you have is enough data to be able to say, how did January become February and how February became March? And you can backtrack on some of the decisions that you made. Now, in this series, we are going to talk about the other accounting methodology, which is called managerial accounting. This is financial accounting. Managerial accounting is the same numbers, but cut differently so that you can look at the immediate effect of decisions. So we'll get to that, but it's not going to be for a couple of weeks. So I need to get out of here. So you listen to IBGR, the International Business Growth Radio Network. My name is William Eastman. This is Finance Monday. This is our series on owning the numbers. Don't go anywhere. We'll be right back. Okay, to enjoy our music here and our commercials. So here's, I'll shut that off. That'll drown me out. Okay, so you can see that we got a commercial in Spanish. It tells you the international nature of what we're doing here. But fundamentally, what we're trying to help with and what we're setting up is that so that you as the business owner have all the tools. Everything that we do on the air is DIY. All right, do it yourself. And so if you follow the shows, we have a listener guide that is now prepared for season 12, and you can take a look at it. Who do you want to follow? What topics do you want to follow? And this is all based upon where your business happens to be at the moment. But there's no reason why you can't do that. And if for whatever reason you say, hey, I'd like a little bit more assistance, you can put comments into the show notes that are on the webpage, or you can just join us over at LinkedIn. And that's the IBGR growth community over at LinkedIn, and join that group. And what will happen over there is that you'll receive all this information anyway. All right, so we're coming down to the end of the commercials here. And again, I can't believe I'm doing video. I swore up and down to our game that I would never go here. And but here I am. Okay, so when we come back, what we're going to talk about is we're going to pick up on episode 2 and podcast 2. And in the show notes and also on LinkedIn, I put up on the newsletter. And so what you can do is in the newsletter that we're running, you can take a look at all of this and track along. All right, so let's see where we are in the music so we get everything queued up. So welcome to the world of live radio. And we're back. You're listening to IBGR, the International Business Growth Radio Network. This is part of our live webinar series, something that we are starting this week. We're going to have one show every week, and it's going to alternate. Today is Monday, Finance Monday. So we are talking about what we've covered last week or in the previous week. Since last week was the first week of the season, there's only one show. And the opportunity here is for you to put in comments, ask questions, etc., etc., etc. On the screen, what you should see in front of you is the link that will take you to the show notes. If you're on LinkedIn, I've already posted them up there as part of our newsletter. All right, so our second segment here is, what are we talking about? Well, we're going to take the first of the basic financial reports, and that's going to be the balance sheet, okay? And so balance sheet, it's 101 for business owners. I almost feel bad about starting here, but we're dealing with people around the world. We're heard in 183 countries, and I don't know where you're at. Where is your level of knowledge in finance? So I have to start with the basic. I can assure you by the third show, we're going to be talking about more advanced concepts. But the balance statement or the balance sheet, all of you should be familiar with, whether you do your own accounting or you have it done by somebody else, is nothing more than a picture, okay? A picture of what happened over that period of time. Now, if you have an accountant or CPA, you get the phone call, the last day of the month going, do you have everything in? Because we got to close the books out. And then they close the books, and typically a week or two later, you hear from your accountant or your CPA, and they go over the books with you. And that type of help is indispensable. There's some challenges with it, which we'll talk about later, but basically the balance sheet says, okay, we're going to look at three things. We're going to look at current assets, we're going to look at non-current assets, and we're going to look at liabilities. So current assets, what's that? Well, that's the cash or cash equivalents. All right, how much cash do you have in the bank? A cash equivalent could be you've got a $15,000 line of credit, which you have not used yet. All right, we'll talk about that later. It could be accounts receivable. In other words, you have delivered the product or service to the customer, you have billed them, and now you're waiting to get paid, and also inventory. This is one of the reasons why the balance sheet is not necessarily the best marker about how you're doing, because if you got a lot of inventory, it's going to make you look inflated. Now, you spent that money. So the thing I want you to consider with inventory, it is cash collecting dust. Now, if you're in services, more than likely, you don't have a lot of inventory. Now, I can tell you that you do, but it's not accounted for. So let's just give you a side here so we can get a little bit out of the basics. And that is, when you have a number of people working for you who are billable and they're sitting around, that's inventory. And so if you're going to pay, unless they're on pure commission, but let's say these are consultants or coaches, you're going to pay them no matter what. So you better use that inventory up. And I don't think this season will get on that one, but I'm working with some ways of adding that to the accounting because I think it's absolutely critical. And then you can take a look at your inventory, if you have any, and you can subdivide that into raw materials, the stuff that you order, you put on the shelf until you need it, the stuff that's on the floor, work in progress. Now, you do this with a service business. And a service business is that if you start a project and it's being handled and it's taken 2 or 3 weeks, you want to measure that. And the reason you want to measure that is every day people are working that it is not a finished good that you can sell or you have sold to a customer is a day you can't collect cash on it. All right. And then the final part of that is finished goods. So inventory can be divided into raw materials. You haven't done anything. You bought the basics, work in progress. You're taking the basics and you're doing something with it. And then finally finished goods. All right. So that's one. The second one is non-current assets. Okay. And that includes machinery, computers, land, buildings, and intangible assets like goodwill, brand, patents, etc. Also included in this group is depreciation, which represents economic costs over the life of the equipment. All right, so that stuff there, it's a drag on your business, but it doesn't give you the numbers that you really need. You got to have it. You got to report it. This is standard stuff. In the United States, it's called the Financial Accounting Standards or FASB, the requirements you have to meet. Otherwise, your banker, if you've got loans or lines of credit, or the IRS will have unhappy conversations with you about it. These are things that we've got to do. Now, on the liability side, pretty clear. It's the stuff that you owe on. Okay, so that's in two groups. That's current and long term. So current is, let me see here. Current is the stuff that is basically due now. Long term are debt that does not come due within the 12 months. So again, let me say that. The current liabilities are stuff that you're going to pay off in a year. For example, you are using a platform like we are with radio.co, which is our broadcast platform that we're able to bring these programs to you from. In that program, we pay every month. We don't pay yearly, we pay monthly. Okay, that is a current liability. As opposed to if we went out, we haven't done this, but if we go out, or if you've done this and you've leased a car for 60 months, 5 years, then that is more of a long-term payment. So really what you've got is you've got current assets, which talks somewhat about money coming in as well as money hanging around. You have non-current. My screen just went blank. So I'll just work from memory. You'll have non-current, okay, more machine in the conversation. If something that we're going to be talking about later is, for example, you get that machinery, maybe you shouldn't own. Maybe you should be leasing that or renting that when you need it. But my experience in manufacturing, going back to my last couple of business turnarounds, is that any equipment that was not at 80% utilization, we would try to make a decision about if we want to use that or to get rid of that equipment because we paid for it, it's in there, and it's an item. Now, the way I looked at it, and I back in the days when I was in the corporate world, is that when you look at anything, you're looking at a multiple at least five times. So what I mean by that, I buy a piece of equipment, and over the space of a year, does it give me 5 times the investment? Or I buy a piece of equipment, and for tax purposes, we can depreciate it over 5 years. So over 5 years, do I get 5 times what I paid for it, which includes the interest? Do I get 5 times that to support that I ought to own that equipment? And if the answer is no, then you ought to be looking at something to do with that and then the liabilities. All right, so that's kind of the basics of the balance sheet. It's absolutely required. I think it's good for 40, maybe 50% of what information you need to have. Beyond that, it is more of something that you're doing to satisfy other people. All right, so that's what I've got here for the balance sheet. Now, anybody got any questions or anything that they want to add to that? Otherwise, hey, Raj, how you doing? And Hugh Hornsby used to be on the network. He's a vice president of a sales organization. I won't mention them at the moment, or maybe I should, but I won't at the moment. And then Raj Kapoor, who also is a mastermind in wealth generation, and he was a former host here at IBGR. Now, by the way, everybody used to be at IBGR is always at IBGR. You're always part of our particular family. But I would say to you that owning the numbers is absolutely essential. Now, it's essential no matter what the economy is doing. But let's face it, when things are good and you're fat, what happens? What's the dynamic here? And that is there's a tendency, if you think you can make another dollar, there's a tendency to go out and perhaps throw money or bodies at it. In other words, we got a new market. We could go into there. We could sell this. All we have to do is hire 2 more salespeople. Now, in good times, what you're thinking is the velocity of money coming in is going to cover that. And so what happens to companies in an economic expansion is they get sloppy. No matter how frugal you try to run the company, and we are pretty frugal around this place, I can assure you, and I'll say why in a minute, besides the obvious. But even the most frugal companies begin to spend money that they shouldn't spend. And when a recession starts and you're at that point where you're about to slide from a expansion into a contraction, okay? as you can see my hand move, uh, you should be going after this going, I know that we didn't spend our money wisely. So owning your numbers is absolutely essential at the beginning of a recession. So you can figure out, what are we spending money on that just truly is not giving us a return? All right, so let me conclude this before we go to break, and I won't get rushed this time. And so this is part of a track series that we're doing. On Mondays, we're doing finance for small businesses, and we're going to move from basic stuff like today to some fairly sophisticated concepts. Support is there. I'll talk about how to get the support in a minute. On Tuesdays, we're going to be talking about operations, and Monday is owning your numbers. That's the theme. Tuesday, the theme is becoming the lowest cost producer. And lowest cost producer is not a price issue. It's simply, how do I improve the quality at the same time decrease the cost of production? And when I say production, don't think about manufacturing alone. Think about this in terms of service as well. When we make something that we sell to somebody, whether it's a product or service, are we building it at the lowest price possible with quality that matches the promise that we made to the customer? I can guarantee you this. I will almost be willing to put a paycheck on it if I was collecting paychecks. And that's this, is that if you've never done this, 10% of your cost is laying around. It's gold on the ground. It's low-hanging fruit. You've heard all those cliches. It's ready for you to grab. And that's what we're going to be doing on Tuesdays. Our live show for Tuesday on operations and lowest cost producer is going to be next Tuesday. Then the third one is sales is going to become more difficult in a recession, and that even if you're able to attract new customers, more than likely they're going to go for your lowest cost offer simply because they're worried about money or they may be short. And so the companies that have been successful have been able to hold their best accounts, their most profitable accounts. And what do you have to do that? And we're going to spend a lot of time talking about customer service as sales. I've always believed that customer service is not a random act of kindness. Customer service is, in fact, sales. You're upselling. Okay, with that, so you listen to IBGR, the International Business Growth Radio Network. My name is William Eastman. I'm a host for today's show called Owning Your Numbers. And our first is base bits. Don't go anywhere. We come back. We're going to be talking about profit and loss or income statement. All right, so we're break here. So, Hugh, Raj, anybody else you want to put it questions or comments you want to make or directions you want me to take, or anybody else who's listening? I don't want to talk to two friends of mine alone. If you're watching or listening to this, then what I want you to do is, if you want me to cover something more than I covered it, or you want me to kind of go on a tangent, rest assured that unless you're asking something very sophisticated in finance, I more than likely can handle it. Not because I'm a finance expert. It's simply I got 4 decades at it, and I probably have seen most everything you can see. All right, so where are we going to be going here as you all come back? And we go back live onto the radio network. By the way, the radio network can't hear me right now. We're not connected. And that is, then we're going to be talking about the profit and loss statement, the income sheet. Good job. In my mind, 50% way there of explaining what happened to month is going to be taken care of. So let's put it this way. About 50% of the balance sheet is usable by the business owner on a day-to-day basis, even though you only get it once a month, okay? So you take that 50%, you got that, and then add another 20 to 25% on the profit and loss or income statement. That will tell you, for the things that you really do control, how did you move from where you are to where you're going, and then the uses and sources of cash or cash flow statements, the other one. And the cash flow statement is actually the statement that probably gives you the best picture of what's going on. And one of the major challenges that small businesses have, all businesses have it, but small businesses especially, is that what you've been doing is you've been living off of the velocity of cash. In other words, in an economic expansion, cash is coming in faster than it's going out. And when I say cash, I mean cash, but I also mean accounts receivable, paid by credit card. In other words, revenue in. It comes in faster than it's going out, and it creates an illusion you're making money. All right, so here we go. I'm going to put on the music for just a second, and then we'll rock and roll into our third segment. Well, that was quick. Okay, we're back. You're listening to IBGR, the International Business Growth Radio Network. You get to see, you get behind the scene here. If you're watching this, if you're listening on the radio station, then it's just another audio program. However, if you're watching on our LinkedIn page, my page, William Eastman, or LinkedIn IBGR Growth Community, you'll be seeing us live. You'll have to put up my mug for a bit. Or if you're on our IBGR Network business page on Facebook, you'll be able to see this. Now, the goal behind my doing this and why I'm not really covering content, in this particular case, I'm reviewing a piece of content that I did last Monday. The idea behind this is that the problem that we have with radio, and we're radio people, we're not video people. We're doing video because we believe it's required. But the problem with audio is that audio is passive. Good news around it is that you can work all day and have radio or podcast in your ear and listen to it, and you can still work. Now, every once in a while, you'll hear a gem and you'll slow down and go, God, I got to write that down. I hope, okay? But we're used to being able to multi-track if we're using our ears because it doesn't require our eyes. The problem with video is that with video, really to watch video, you can't work and watch video. I can't. If I'm getting prepared for something and I need to work, I have my notes ready to go and I'm building show notes like we did for this. I can't do that if I'm watching a video. I can do that if I'm listening to something. So we made a decision that we're trying to help our customers, our clients, our audience in 183 countries around the world. How do we help you apply the concepts and principles that we cover? Because IBGR as a network only does three things, really, besides the news, but the news aside: how to start, grow, or exit a company. And so the idea behind that, when we designed this, coming on to 3 years now, is that if, in fact, we can help you do it yourself, then all you got to do is listen to the shows. Now, right below on the screen, if you're looking at it, you'll find the link that'll take you to the show notes. It's also in our newsletter for today. Now, on the other hand, if you're watching this, then you just got to click that link or go to ibgr.network. That's our website, our homepage. When you get there, go to resources, mouse over the navigation bar, which says resources all the way to the right. You see show notes and click it. And what you're looking for is show 12 or S12 and episodes 1 through 4. This is episode of podcast number 3 from what we did yesterday. Now, our first segment, I kind of laid this out, what we were doing, kind of introducing this concept of why we're doing video. Our previous segment, the last one we did, we talked about the balance sheet. Now, here we're going to be talking about the income statement. So if you're looking at those show notes, that's good. If you're looking at the newsletter, that is great. So let's talk about what the income sheet is. All right. And I apologize if you already know this. Let's just good refresher. Maybe you'll pick up something from me. All right. So the income sheet, or also known as the profit and loss statement. All right. So what does that tell you? Well, when you look at the balance sheet and you're trying to figure out how stuff moved from January to February, or in this case, you should have December numbers. So you're trying to figure out what happened in December that affected the numbers that I'm seeing from the change from the November sheet. All right. So the income statement, it's a picture of the process. It's really what it is. It's a picture of the business conducted over the month. And again, it as a P&L statement. I'm just using various terms because sometimes, depending upon the country that you're in, there's different ways of talking about it. But it tells the business owner really what was the level of profitability over the month. So it becomes more of a crucial document. All right, you need to know that. And if you got investors, hey, this is the one that they're going to be scrutinizing pretty close. Okay, so it's a picture of revenues and gains. It's a picture of expenses and losses. And it explains how the balance statement or the balance sheet change month to month. Now, what it provides you is an insight into the efficiency of your operations. Now, when we get into operations on Tuesday and we talk about lowest cost producer, those numbers, those gains that you'll get from doing that will somewhat show up in the balance sheet. But here is the place where it's going to be obvious. Because what you're getting is how efficient are you at running? How well do you manage the resources of the business? And how is your company performing relative to the industry? So let's take a look at those three. So the efficiency of operation is, where do you stand in terms of cost producer? I didn't say lowest cost, I said cost producer. And as I've talked about it in the previous two episodes, is that this has nothing to do with pricing. Pricing is a totally separate issue here. This is, what does it cost us to make it today? And what we'll do is, I believe next Tuesday, when we do our next live session next Tuesday, I'm going to be talking about how to get at those numbers. And as I said in the previous one, if you've never done this before, my guess is 10% improvement. In other words, a 10% cost reduction without affecting the level of quality or service is not only possible, it's probable. You would be hard pressed not to find it. Because one of the things of going for the lowest cost, if you do it the right way, and we call it value mapping, which we will cover in a couple of weeks, is that it has you look at each step to say what value is being provided. And it's a three-way test. And we'll go into detail here. I'm going to do it later. But basically, you map a process out. This is pretty simple. You take your operations, we make X, or we provide X service. You take one, and you map it out from beginning to end. All right? Now, one of the things that happens, if it's just you and another person, there may not be a lot of insight gained other than educational piece. But if you've got a company of 40, 50 people, and you put that process up, and let's say that there are 10 people involved in the process, here's what you're going to get. I didn't know that. I didn't realize we did all that. You're going to get, why are we doing that step? It doesn't make any sense. And so what you begin to get is not only an education for everybody of what does it take to make something or deliver a service, but you get to question each one of those steps in the process going, do we need to do that? And that's where this value mapping comes in, because what is the value that you're looking at? Well, number one is it something that if you itemize the bill, the customer would pay for? If the answer is yes, keep it. If the answer is no, let's move on to the second question. And the second question is this a step, a requirement for, say, quality or engineering? In other words, we got to do it that way, otherwise we can't engineer the part, or we can't deliver the service to the service quality to the customer that we promise if we don't do that step. If you get an answer yes to this, keep it. The third one is, are we doing this because of regulation, environmental concern? Is there something outside of you that compels you to do it, and if you don't do it, you're in trouble? If you get a yes to all three, then you're going to keep it. And now you're going to be trying to figure out how to do that step better. But here's what's going to happen when you do this. You're going to get a no, a no, and a no. And then when you turn to somebody and say, why are we doing that? More than likely, you're going to get, well, 10 years ago when Fred was here, Fred thought that this was the best way of doing it, and that's why we're doing it today. If, in fact, you don't get a yes on those three questions, it's gone. And that's how you get at the efficiency of operations. And the income statement is the results of that. That's what you're going to see when you get that progress. Now, the management of resources has to do with what you buy and where you put your energy. Now, if you're in manufacturing, the biggest one is inventory. The biggest area you get hammered is in the area of inventory, because as I said earlier, if it's in there, then you basically you can recoup it. We're not things that we stress with small business owners is that if you're not on top of this type of stuff, you wind out financing things, service business, the management resources is labor. Do you know people? Are people fully engaged? Most of the things I did when I was running consulting companies, my own companies, is that we had a thing that was all project management based. So what we looked at is the fee per day that we could charge for that activity or for that person. And we looked at their utilization ratio. In other words, of the amount of time that they have available, how much of that is actually booked to be working on this particular project. And then we looked at associated cost. And so whether I'm trying to manage things or I'm trying to manage people, whether I'm looking at equipment and inventory or I'm looking at human beings, I can look at the management of resources here in my income statement, and I might not be able to determine why it's happening, but I can say it ain't good. And then finally, performance relative to the industry. I would seriously recommend everybody out there to get a Dun and Bradstreet / Hoover's business account. Okay. Now, the reason for doing that is if, in fact, you pay to be into their service, and you can either pay a monthly or yearly subscription, or you can buy reports when you need them, your choice. You run a dry cleaners in the Mid-Atlantic region, United States, and you got 5 stores. How are you as a business performing against other dry cleaners with, say 5 to 10 stores in the Mid-Atlantic states of the United States? What you want to be able to do is compare yourself to the industry, because Dun & Bradstreet does a pretty good job of, even though it's self-reporting from small businesses, big businesses, they have to file in the United States with Security and Exchange Commission. So they take it right off of the reports that they give the SEC, and if you lie on those, you go to jail. But here what you have is you can look at it to say, right now, our costs are 10% higher than the industry average for our industry in our region. So where do we go here? So those are the good things that come out of the income statement. So not only can you go, or profit and loss, are we making money? What's the profitability of the operation? But it gives me things to look at. It gives me, do I look into operations, getting more efficient? Do I look at how do we manage resources, whether they're things or people? And how are we performing relative to the industry? And more than likely, the way I would do this is I'd work backwards, and I would start with performance relative to the industry to see where we stand there, and then ask the other question, operations and resources. All right, so with that, when we come back, what we're going to be doing now is we're going to be talking about the sources and uses of cash, or the cash flow statement. So you're listening to IBGR, the International Business Growth Radio Network. My name is William Eastman. I'm host for today's show. This series is basically called Owning the Numbers, and today we're just doing some basics on financial reporting. You can catch us on LinkedIn, on my page, William Eastman, or in our network, our group page, and that would be IBGR Community, as well as the IBGR Network page on Facebook. Don't go anywhere. We'll be right back. All right, for everybody. So I just responded to some comments. So if you're on LinkedIn or Facebook, you're still seeing this. And so what happens here at a radio station is that, and I'll just turn it on for a second. What's happening here, if you're the studio engineer, is that you are now playing whatever's up. And right now you've got Ben Goya. You want your own commercial? You want to be talking to me.com. All right, I'll shut that off. And so what you're doing is you're monitoring, and you're looking at your notes, and you get ready for the next piece, as well as you're responding. You are responding to people who are watching you. Okay. And as I said earlier, the reason that we went to this is that we were trying to get over the conundrum of radio as passive, and people are trained with radio or audio to be passive. You listen to podcasts, you're passive. It doesn't require any interaction. But if what you're doing is you're trying to provide to people a do-it-yourself approach, in other words, materials that you could use with just listening to improve your business, there needs to be some interaction in that. So we're testing this. This is our first show that we've done this way. And it's obvious that we've got to be working on, we got to get a prettier host on, and that's not going to happen for any time soon. But also we have to work on our studio dungeon here. It's a great radio broadcasting, but apparently what we need to do is we need to go to video. So let's see here where we are on the music. Okay, so for everybody, that's the bumper music telling me I got to be on the air. Let's go. And we're back for the fourth segment today. You're listening to IBGR, the International Business Growth Radio Network, heard in 183 countries. IBGR is our call sign. IBGR.network is our name. It is our URL, and it is our broadcast frequency. If, in fact, you would like to get your show notes to follow along if you're listening solely on radio, then you need to go to our website, IBGR.network. When you get there, navigation bar, look all the way to the right. You see resources, mouse over. You'll see show notes, click it. And the show notes that you want should say something like Owning the Numbers, S12, Season 12, Episodes 1 through 4. And that should pop up. Okay, now if in fact you're watching on Facebook or LinkedIn, Facebook would be on our business page, IBGR Network. And if it is LinkedIn, it's both on our community, IBGR Growth Community, as well as my personal, William Eastman, my personal LinkedIn page. You can see it there. And what should be showing on the screen below me, it should be covering up my face, but I didn't make that happen, is the link to get the show notes. Now, here's what we've done. Here's what we're going to do. The first one, I just kind of introduced what we're doing here and the basics of financial reporting. The second episode, by the way, this is episode. So episode 2 was talking specifics about what you can do with a balance sheet. Episode 3, the previous one we just did, we talked about what you could do with an income statement or a profit and loss statement. Now what we're going to be doing is taking the last of the big 3. And this one is, depending upon where you're at, cash flow statement or sources and uses of cash. Now, the reason that this works well, and this may be the best tool out there, the one I pay attention to, because ultimately, to get through a recession, it is the management of cash flow at the end of the day that's going to make a difference. All right, so cash flow statement explains the process, okay? How the income statement, the profit and loss, created the balance statement. In other words, when you looked at the income statement, that shows up in the balance statement or the balance sheet. All right, so it reorganizes the information from the income statement into operations, investing, financing, and supporting. So it's a great breakdown because some of these are important to you, some of them are not. So we'll look at this. So operations. All right, so addresses the sources of cash. Investing covers how gaining assets, okay, were gained to operate and grow the business. So sources of cash, you're going to say, okay, we took in, let's say your bricks and mortar. We took point of sale, cash register sales. We got an online e-commerce element. We took it in that way. It would also potentially break it down into was these credit card statements, actual cash, or now where we're headed is buy now, pay later, or crypto. All right. Now, gaining assets are things that you purchased to operate and grow the business. Now, let's understand asset. And here's a rule that I was taught in my very first business. I wanted to be a mechanic eons and eons ago. Okay. And I wound up putting myself through college with a number of jobs. And one of them was working as a motorcycle mechanic. So I went to a local guy that I kind of knew, a guy who was an escapee from Cuba. And he taught me small engine maintenance. So I would rebuild one-cylinder engines, Briggs and Strattons for him for lawnmowers and things of that nature. And so he taught me a little bit about the business. And he emphasized it's all about the cigar box, okay? All about the cigar box. What's in the cigar box is all that matters. And so when you use money, he said, here's the rules of using money. And I will apply this to credit as well. Number one, is it an asset that appreciates in value? You buy it and it's worth more a year from now. Or number two, it's an asset that produces money. Okay, piece of equipment that you can use for that matter. Okay, he said, if in fact it doesn't do those two things, seriously consider, and I can't copy his accent, and I'm upgrading his language a little bit and saying things that he would say to me that I can't say on the radio, but otherwise, don't buy it. Don't blank and buy it. Now, you may need a car for the business and it's for you and you're going to lease it and all that. But understand is going out and getting a brand new Mercedes and thinking that that's going to help you with the business, You already know the answer to that. It makes you look good and maybe it provides some stature, but an automobile provides no revenue from it. Also, it provides what? This is a depreciating asset. You drive it off the lot, it's worth 20% less. Whereas an asset of like going to a guy like Hugh Hornsby, if Hugh, you're still on, and getting a professional sales organization and bringing that asset into the company. Now that matters because why? Professional sales organization is going to do what? Produce more revenue. So when you gain an asset, if it doesn't appreciate in value, then it better either go to operations or something to grow the business, but ultimately has a cash payoff. All right, financing. All right. So now this is financing, taking a look at it in terms of have you financed, have you gone out, and are you getting money from other places, shares and dividends? Okay. Now, most small business owners, this is not, they're not taking any dividends from anything and they're not paying any out. So in the early stages of the business, it's blank. But pay close attention to this item because something later on may happen. For example, you're profitable. And what do you do with retained earnings? Now, again, I'm not a financial expert. I'm just a business guy with 40 years of experience. 40, what is this year? This is 2023. 44 years in the business. Okay. I hate to say it, but if you look at my face, you go, yeah, that's 44 years. All right. So anyway, it looks like more than 44 years, especially, I only look 44 years in the business if I started at 10. But getting back to that, okay, is that you take retained earnings, and for the sake of this conversation, I'll make it easy. That's a pie. Retained earnings is what's left over. All right. You take that pie and you cut it into quarters. The first quarter is the first 25% of retained earnings is put back into the company. You're reinvested back into assets that are going to grow the business. And the beauty of that, that's pre-tax money. So you don't pay taxes on it. Okay. Another 25% you'll hold as cash because who the hell knows what's going to happen next. All right. So that leaves us half the pie gone. Some of that is pre-tax, some of that's post-tax. The third pile is dividends. I tell all business owners, the smart move is pay yourself something that the company can afford and is reasonable. Don't overpay, don't underpay. Make your money off of the dividends. And what that means is that you're kind of like a salesperson. If the company has a great quarter, and because of your management of the firm, that's your commission, and you take a dividend. And when you take a dividend, that's a capital gains and a payroll. So you're paying less taxes on it. Well, that leaves 25%. What do I do with the 25%? Well, the 25%, maybe what I want to do is start investing in other things outside of the company that are going to produce revenue. Could be stocks, could be bonds. I'm not telling you where to put it, but the smart move is what if you used your company as a bank and actually used that to finance other things that brought cash into the business you didn't have to work for? Okay, just a thought there. And so if you buy a building to put your business in it, that's probably not part of this, but you got money left over, you buy an apartment complex and rent it, and you got the rental fees coming in. That is what we're talking about here. So the issue of financing for most business owners is not big, but don't pass it up. And then finally, supporting. And supporting are the things that are non-financial transactions that support the business and whatever taxes are paid during the month. Okay. So what you got here is that you're looking at what's coming in and what's going out. And this gives you the complete picture. So if you take your balance statement or your balance sheet and you got your picture of October, November, December, and we're in January. So you should be this week looking at December numbers. Your account typically hits you mid-month. You can see how the business has changed over time. You go to the profit and loss or the income statement to begin to go, how'd that happen? And so you get one picture, but it doesn't tell you the complete picture because it has things contained in it that are used for tax purposes that don't give you an accurate picture. And then finally, you have the profit and loss statement, the sources or uses of cash or the here I am talking all the time, the cash flow statement, and that tells you actually what occurred. If you're on top of those three and you can trace it back, because what we're talking about here, all of these numbers represent results, all right? It tells you number one, are your results acceptable or not? Now, let's just put them into two piles. If they're not acceptable, now it gives you the ability to backtrack. So, do I look into operations, which is why we have an operations track? Or do I look back at how we're managing our accounts and our customers and how we're selling? Now, I didn't include the people track here because it was just going to be too much to manage. You could add another track saying, who are we hiring and how well are they performing? But I'm going to leave that out because for small businesses, that's typically in a recession, that's not the issue. It is managing cash flow, getting my costs down as low as I can without sacrificing any quality or anything we promise to the customer, and holding the best accounts that I have. Those are the three things that I need to do. All right, so where are we going from here? Well, what we're going to be doing on the finance side is that we're going to be moving into activity-based costing, and that's going to set us up for lowest cost producer. So we're going to be talking about the other way of accounting, not financial accounting, managerial accounting. And it's the same numbers. It's not double bookkeeping. So it is double bookkeeping in a sense. But what I want to say, it's not like you're keeping two sets of books, one for the government, one for you. This is just taking the same numbers and putting them in different piles to understand what is happening inside so that you can backtrack, say, okay, I'm not happy with my operational numbers. Where's that coming from? And if I don't know where it's coming from, I cannot fix it. Okay. And so that's what we're going to be talking about now. Next week in operations, we're going to be taking the whole value mapping process down and how do I become the low cost producer? That's what we're going to be doing next Tuesday. And then the following Wednesday, we're going to be pulling together everything around basically, you cannot manage your customer relationships without sound data. And then based upon that sound data, what do you know the customer is saying about the quality of the products and services that you sell, how user-friendly they are to use them, and what is it like to do business to you? If you can conquer those three, what will now happen is that you're going to hold your best accounts and set you up for the expansion. So I greatly appreciate you listening on this first run here. And next week, it's going to look a whole lot different. So you're listening to IBGR, the International Business Growth Radio Network. My name is William Eastman. I'm the host for today's show. Today's show is Owning the Numbers. And this theme of this Monday series, I should say, is Owning the Numbers. And today's show was on the basics of financial reporting. Greatly appreciate you listening or watching, no matter how you got here. The fact that you got here is awesome. Don't go anywhere. We got 5 hours of great programming coming right now, and then we'll be into the news. Have a great business day. Take care. Okay. All right. Nice comment from Hugh. Hugh said he's going to his board meeting on Thursday, and this will help out. I greatly appreciate that, Hugh. You're a great guy, a great sales guy. I wish we could afford you as the head of our sales, but we are not there yet. And Raj, thank you for joining. And all of you out there that were listening or watching, but we're not commenting, I greatly appreciate you being here. If nobody puts any other comments up, what I'm now going to be doing is I'm now going to shut down for the day. Now, if you want to join this show next week, and I want you to, because my feeling is by the third week, we're going to be rocking this. I had to figure out how to do it. I had to overcome the fact that I didn't personally want to do it and then figure out how to do it correctly. And as we say around here at IBGR, all startups are experiments. And even a new feature is a startup onto itself. And you got to experiment with it. Get it basically right and then expand upon it. So we know what improvements we're going to make. So for everybody out there who's been watching on LinkedIn or Facebook, thank you very much. Next week, we will be on Rumble and we will be on YouTube. You take care.